I was just going through your note where you say that the right way to value companies or stocks now is on an EV and operating cash flow basis rather than a price to earnings or EV to EBITDA basis. So if you look at the EV enterprise value to operating cash flows, which are the companies that look cheap or look attractive from a long-term investor's point of view?
Yeah, good afternoon. I think this approach towards looking at cash flows is something that we started realizing about a year back, when the dichotomy between earnings and cash flows was quite stark. We were in a kind of a abnormal phase over the last 4 years, where earnings growth was muted, but cash flows were very robust. It appeared as PE re-rating driving stock prices, and it was misleading us for a fair bit of time, where we thought stocks were getting too costly on vis-a-vis their traded historical averages. But actually, when we realized that, when we went through the balance sheets after the annual reports came, we realized over the years that actually the cash flows were growing much faster than earnings. And the reason for that was we have never in our maybe 20 odd years seen a 3-year phase of deflation of commodity prices, due to which WPI was almost negative for a long period of time. And due to that, earnings was muted, and we pay multiples for nominal earnings, not real earnings, whereas those got that much muted to that extent. So the full benefit of the falling commodity prices came to the balance sheet. It led to inflation coming down, due to which cost of capital came down, and that also led to better valuation. So we were in a phase of far better operating cash flows and far lesser cost of capital, which is a very good potent combination for valuations. That's no longer beginning to play out. We think that phase, which lasted about pretty much 4 years, 14 to 18, is beginning to moderate. And with the way the commodity prices are going up and the rupee is depreciating, we think the effect of this will start showing up. So we are going to see another 18 odd months maybe, where it will be an opposite of the picture we saw earlier, wherein cash flows will start to moderate, go slower. Multiples, if they correct, will appear that it's getting cheaper on PE, whereas it's getting actually costlier or maybe not getting cheaper on cash flow terms. So that impact is beginning to be seen. We are kind of highlighting this point, telling investors to not just be heuristic, where it's simple to value it on PE, but it's actually not as easy as it appears.
Okay, I just want to highlight a couple of the stocks that Spark Capital has pointed out, where this new parameter that you could start looking at perhaps, which is the operating cash flow. The EV to operating cash flow is fairly reasonable. So comparatively, those stocks look cheap. Imami, Apollo Hospitals, Shree Cement, ACC, Whirlpool, these are some of the names that have been cited in the report. Whereas companies with healthy cash flows, there's some other names as well, like VRL Logistics. Of course, Ashok Leyland is one of them. So these are some of the names. Ganeshram, however, the question is, so in the mid-cap side of the market, where anyway it's becoming so difficult to pick the right stocks right now, what multiples should be followed? Is EV to operating cash flow enough? I mean, then how will you then measure growth to that extent? What all are you looking at to now take a call on mid-caps in this environment?
The key thing which we are looking at is pricing power. Raw material prices are going up, or we will also see freight rates go up, or operating costs due to either lease rentals or wages. So you will see a phase where cost of doing business will start to go up. So it's basically boils down to who can pass it on. So the true test of pricing power is over the next 24 months. So we go back to time-tested businesses, and that's pretty much what market is also showing in the last 6 months. The very fact that just a few time-tested companies are outperforming is actually an indication that market is actually looking at historical track record over cycles, not just in up cycle, but across cycles. Who has been able to pass it on in terms of their ability to have the right pricing power? And that's really what we are focusing at this point in time. It's actually a very bottom-up market. lot of changes are happening in terms of the raw material prices, the real cost of their business, which really wasn't a concern over the last 3 years. Now it's showing up, and that's where the stock performance diversion is also quite, the polarized nature of the market is actually showing up now.
Okay, then one final question. If we can just drill it down to individual stocks, there are companies like, say, an Ashok Leyland, an Imami, a Dalmia Bharat, and NIIT, where you speak about healthy cash flows. And stocks like Imami are also cheap on an EV to operating cash flow basis. So would you suggest that long-term investors get into names like these, Imami, Whirlpool, Ashok Leyland, etc.?
I won't specifically talk on stocks, but yeah, there are many stocks out there who are not cyclical, who are not fair weather friends. They are all weather, as we term it, and it is important to get biased more towards stocks whose track record is not just doing well when the tailwinds are there, but who have the ability demonstrated over years that they can actually do well across cycles.